This is the beginning of a massive earnings seasons for many companies, and today we are going to run through a few key ones that have already reported. We're going to take a look at Tesla and Texas Instruments that reported yesterday before close, and we're also going to take a look at 4 others that reported today. We're going to take an interest in AT&T, Humana, as well as an incredibly strong company that you may not have heard of, ODFL, which is on my watch list, as well as CNI, Canadian National Railway, which isn't on this list. Now, before we take a look at those, let's just have a look at the market that is essentially today. We can see quite a lot of red across the board. We see these semiconductors. In fact, Nvidia alone is down 2.5%. And we also see one of the bigger names, Tesla, which has been beaten down. It is up 9.36%, and we will touch upon that in today's episode. So what we're going to look at, each one of these companies, we're going to look at their earnings, how they reported, whether they beat, whether they miss, any signs for future growth in their forward guidance. We're going to take a look at how they historically have performed and do a nice deep dive into them, look at their dividend safety. We'll touch upon their financial metrics, and for each one we are going to look at the valuation. We're going to get to the intrinsic value, get to our own acceptable buy price given our investor margin of safety, and see what Wall Street are forecasting for each one over the next 12 months with any upside, and take a look on whether we believe they are some strong companies to buy at the current value. Now, before we do dive into 6 of these companies, we do want to let you know we have released our latest free weekly article. Now, it's free. Do click on the pinned comment below to sign up. But in this article, we run through all the stocks, resources that we use, where we find them, the websites, and you can also gain complete free access to get to these other articles as well. So the first stock that we're analyzing today, it is Texas Instruments, and we can see their earnings and revenue surpass analyst estimates straight off the bat. When we take a quick look at their numbers, they did report for this quarter $1.20 per share, and we can see significant beat from what analysts were targeting of $1.06. But do bear in mind, last year, the same quarter, they did report $1.85. So they essentially beat on the earnings per share versus analysts, but they did miss when you compare it to the previous year. On top of that, when we look at their revenue, what we can see is, in fact, they did beat on the revenue. They posted $3.66 billion for the quarter, and as we can see, a very marginal beat, nonetheless very strong at 1.52%. And again, when you do compare it to the previous year, they did unfortunately have lower revenue. So in conclusion, for Texas Instruments, they beat in comparison to analysts on the revenue as well as their earnings per share, but when you compare it to the previous year, they are both lower. Nonetheless, the market has posted very positive response. It is up 6.31%, which is interesting given the fact that it is significantly lower than the same quarter from last year. Now, this is a company that is trading in the mid to upper end of the 52-week range. We only have 1 buy rating from Seeking Alpha Analyst, 2 holds from Wall Street and Quant, and we do know over the last 12 months it is pretty much flat. Now, if you've been a shareholder over the last 10 years, you would be up a strong 284%. Bear in mind, though, this would be higher if you were to reinvest those dividends, which currently the forward yield is at 3.14%. We would also say the forward P does sit much higher than the S&P, which is around 22. Now, TXN's PE on a forward basis is around 32.14. So let's take a look at this company. First away, dividend safety, 80, it is looking to be safe. Market cap, 151 billion. It is a mega cap company. Now, in terms of the recessionary metrics, so last recession, they increased the dividend during the 07-09 crash. They had below recession sales, negative 27%, when the S&P itself was negative 12, and they also had a near S&P return, negative 59, with the S&P bringing in negative 55. TXN is one of these companies that I used to think of as a very strong dividend growth company. It still is, but you will see the disappointment at 4.8% increase to the dividend last September. Now, that is pretty much slightly higher than the average inflation rate over the last 40 years of 4%. So you are barely increasing it by inflation. But over the last 5 years and over the last 20 years, we can see they have been growing those dividends at a very rapid rate. We also note they have been increasing those dividends for the last 20 years consecutively, meaning 5 years away from becoming a dividend aristocrat, whilst also paying dividends without a reduction for the last 62 years. Now, more for the newer viewers, essentially dividend yield theory states a company is undervalued when the current yield sits above the 5-year, so we note a sign of undervaluation, although when we do look at the forward P, it is much higher than the 5-year average. So again, bear that in mind, but as always, any signals, undervaluation or overvaluation, we don't look at any of these models in isolation and will conclude towards the end. Information technology sector P is also much lower at 25.1. Now, talking about the free cash flow payout, a few things to note, very key to understand. Free cash flow, we always focus on that. The earnings is susceptible to manipulation by management through accounting. We're going to show you why right now. Typically, below 50% is the target for semiconductors. My own rule, below 60%, so I can have that faith that management will give us those double-digit dividends we'd love to see. But look, if you're an investor in 2023, 338%, this is an incredible red flag indicator signaling that management paid out a lot more in dividends than they generated in free cash flow. When you were to look at the same one on the earnings, you would be satisfied 71%. Okay, it is a little bit high, but not the worst. So again, something to consider. Again, 2024, red flag indicator 181%. They are expecting around 93 on the earnings. So something to factor in. I would be a little bit worried if I was expecting, or someone who was expecting, some significant growth to the dividend at last this year. Free cash flow per share. Now, a few things to note. Firstly, this was something that management did say that they would have a lower free cash flow. We do know over the longer term it did increase, but it has dropped significantly in FY23, one of the reasons why we see that massive share price drop. But we do note it is expected to pick up into FY24 at 288. Sales growth, now again, people will say cyclicality of this industry, therefore we shouldn't see growing revenues year on year. Overall, we do see on average a 3 to 7% when we take the median. And when we take a look at FY23, do be aware they did drop that top line by double digits, negative 13%. Over the longer term, however, they are increasing their revenue, but it is a little bit inconsistent. One thing they do nice are small share buybacks year on year, so returning that excess cash, giving you a larger portion of the company. So something you can factor into your own investment thesis as well. Well, ROIC, return on invested capital, one of my 7 golden dividend metrics, 10% or more, gives me faith that management are able to effectively allocate their capital. Very strong across the board. Still, even though it has inconsistencies, 25% in FY23 is very strong. Margins and margins and margins. So operating margin, very strong. Operating efficiency over the longer term, although we do note the drop from 22 to 23. Free cash flow margin, very strong as well, although we do want to point out it did have a massive drop, and with the trailing 12 months at 6%, they may not be maintaining those strong margins that we have seen over the longer term. Something to consider and maybe impact your margin of safety. Net debt to EBITDA, then, the earnings before interest, tax, depreciation, amortization, corresponding to both dividend safety, balance sheet strength, below 1.5 for semiconductor firms, and that is the number of years it would take the company to pay off all of their debt net of cash on hand, significantly below 1.5 year on year, so they do have a very strong balance sheet, but do note it is increasing from 2023, although marginally. So let's jump into the valuation of TXN. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, today we're jumping straight into the final calculation, but with our models we do deep dives and we run through every single one. So today's episode of TXM, the intrinsic value is $193. Now, with the current price of $176, we start off with that margin of safety of 10%. And remember, we only execute on 10% if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. And we can see it is trading near a 10% MOS level. Now, what are Wall Street saying with TXN? Well, they believe there is very minimal upside. In fact, as we saw earlier at the beginning, they did call this company a hold. They see 2% over the next 12 months with their price target at $180. As always, as we go through these stocks, drop your thoughts below. Are any that you're adding, buying, or maybe they're on your watch list and you're waiting for a larger margin of safety? We then move on to the next company, which is AT&T. Now, as we can see with their earnings headline reading, they beat the estimates for their subscriber additions as well as free cash flow, which is very important for this company that has a significant amount of debt. If you have seen our deeper dives, you will understand what we are talking about. Now, one of the metrics that Wall Street does like to see is a very nice number for the net monthly bill paying wireless phone subscribers. And what we see is an addition of 349,000 in this quarter, with the expectation of 286. So very strong to see that they did increase significantly more than what Wall Street was expecting. When we take a look at their free cash flow, we note it has more than tripled to 3.1 billion, and also on top of that, it is above what analysts were targeting of 2.53 billion. So very positive on those subscriber additions as well as the free cash flow growth. And looking specifically at the revenue and earnings per share, well, revenue came in at 30 billion. This was slightly lower than what analysts were targeting at 30.54, and we can also see that the earnings per share was in line at 55 cents. So fairly positive when we do take a look at AT&T's earnings. We do see how the market has reacted. It is up just under 2%. Now, over the last year, it is still down negative 4%. Over the last 10 years as well, if you have been a shareholder, you would not be going through a good time, down 38%. Again, if you're reinvesting those dividends, it would be slightly higher. Now, in terms of the 52-week range, it is towards the upper end of the 52-week range. We have two buy ratings from Seeking Alpha and Wall Street, and we have a forward yield of 6.73% and a forward PE of 7.41. Now, in terms of the metrics, well, a 60 score, borderline safe, market cap 118 billion, a mega cap company. Now, when we look at the last recession, well, they increased the dividend. They had pretty much above average growth at nearly -1, but they did also marginally outperform with their negative 45% return. Now, one thing to note with this company, as we can be detailed here, they did in fact have a dividend cut not too long ago, hence why the negative 11% year-on-year decrease to the dividend and 0% over the last 20 years, as we can clearly see here. Now, in terms of their dividend growth streak, nothing to note yet, with only 1 year of paying a dividend without a reduction. So let's take a look at dividend yield theory. Now, we do note pretty much a reasonable valuation with the yield not too far off the 5-year, as well as the forward P marginally lower as well. When we compare it though, it is significantly lower than the communications sector P of 17.3. So let's take a look at the payout ratio, which is very important, especially given the fact that they have a recent dividend cut. Now, nice to note, 70% for telecoms. It hasn't been above that since 2017. 2023, 39%, 2024, a little bit higher at 46%, so that does look okay right now. Let's have a look at the further information and metrics. Free cash flow, well, it has increased over the longer term, but very, very inconsistent. In fact, it did peak in 2019 before remaining stable and then dropping. We also want to point out FY24, it is expected to drop slightly too. Sales growth, well, we do have some very mixed numbers, some years of double-digit growth, but they also did have a spin-off, hence that will impact some of the numbers and some of that double-digit negative growth that we can see. But in the first full year after that, a 1% growth, very, very minimal, and in fact doesn't really keep up with the 3 to 7% that we like to see. And remember, they need a minimum of 3 to 4% just to keep up in line with inflation. Shares outstanding, also you can note they would have diluted your position as a shareholder over the longer term. So if this is one that is of interest to you, do bear that in mind as you are looking over your investing thesis. ROIC, now I like 10% or more, 9% or thereabouts for telecoms. They do marginally hit that. It does straddle around that, as we can see over the last 3 years as well. And on a margin basis, at least it is positive to note that they have increased their margin over the longer term. It is for the large part above the 14%, and the same can be said for the free cash flow. It is very healthy, especially the last year at 17%. That is something quite nice to see. Net debt to EBITDA, on the other hand, we do see it straddle around the 3.5 that we like to see as a maximum for the telecom industry. 3.13 noted in 2024, so they are looking to improve that debt, reduce it as well. So there are some positive signs. When we include this with the low free cash flow payout, it does look like that dividend yield of around 7% is looking to be safe. Now, what about the valuation? Let's get into it. And as always, you can grab a copy of this model by clicking on the pinned comment below. You can get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio. So an intrinsic value of $20, we get a 10% MOS level. It does look to be a buy up to $18 if that is what you are looking for. 15% at $17, and at 20% it isn't quite there yet. So for today's episode of AT&T, we have a 15% MOS level based on those estimates and judgments. Wall Street, well, as we can see, that we mentioned earlier, they do see this as a buy. They have a price target of $21 with upside of 24%. As always, let us know if you are adding to this fairly high yielding company. The next earnings that we are taking a look at is Tesla. Now, this was a very interesting one. This did report yesterday, and we can see after the reporting of the earnings, it was up 13%. Now, why I say this is interesting? Well, in fact, they reported a 9% drop in the revenue, which is in fact the steepest year-over-year decline they have had since 2012. And on top of that, the share price is down just around 40% over the last few months. Now, if you want to take a look at their earnings, what they reported, what we can see, 45 cents per share with analysts targeting 51. Revenue as well significantly under at 21.3 billion versus 22.15. So it is quite interesting when you do take a look from the year before where it had 23.33 billion, and we can also see net income dropping 55%. So interesting to note that the market has reacted. Now, you could argue there are reasons for why this was. Elon Musk did also talk about production of new models of cars in early 2025, if not later this year. There was a lot of positive upbeat, in fact, talking about licensing their driver assistance system to another massive car company, and also potential talks bringing out the Optimus robot to be sold at an earlier date than had been expected in 2025. Now, as I mentioned, very interesting. It did seem like very poor results. There was also talk of a cyber taxi, essentially, as well. And we can see it is up 10%, rather on what Elon Musk was talking about, rather than the numbers. As we mentioned, a very poor performance. Now, even with it up 10%, it is still down 2% over the last year. Year to date, horrific, down negative 36%. I believe it is also the worst performing of the Mag 7. But over the last 10 years, if you are a long-term holder, well, you would be up over 1,000%. Now, we do have pretty much hold ratings across the board from Seeking Alpha, Wall Street, and Quant. And we also note it is trading right there towards its 52-week low with a forward PE of just over 52. Now, in terms of looking at the numbers, the metrics, well, what we like to see is increasing free cash flows. Over the longer term, nice to note it's gone from negative to positive, but it has dropped from the highs that we saw in 2022. Nice to note, though, 2024 it is expected to increase, although marginally. Sales growth, well, double-digit increase every single year. The question is, can they maintain that? Can they keep it up? And can we see the likes that we have seen in 2021, 2018, and a few years before, where we are seeing some very strong growth to these numbers? Well, it looks like maybe the market is starting to believe what Elon is talking about and where those revenue drivers can come. He did, in fact, say that Tesla should be measured or, in fact, valued like a robotics company rather than a car company. We can see the astronomical growth to their top line over the last 10 years. We do also want to point out that even though this company has increased dramatically over the last 10 years, it has also diluted your position over the longer term. Something to note rather than really affect any decision making. ROIC, now last 3 years looking very strong, as we can see at the double digits, but before then it has been low and in fact negative. But again, just something to bear in mind. They were in fact making a loss, as we can clearly see here, with a negative operating margin up to 2018. Even the margins we would like to see higher, but again, if you are really buying into the future with the different income streams, then could be a great time to consider a position. And the free cash flow margin, at a minimum, we want to see 5%, and we can see it is there or thereabouts over the last 5 years. Finally, very, very strong balance sheet, 0 over the last few years and expected in FY24, meaning it won't even take them 1 day to pay off all of their debt net of cash on hand. So let's jump into the valuation of Tesla, and if you have seen our deeper dive just a few weeks ago, you will understand where these numbers are coming from, so do check that out if you want to understand the numbers behind this. So an intrinsic value of just under $180, and when we do use a margin of safety of 10%, we can see it is a buy up to $162. At 15%, it isn't quite there yet, although it was before the earnings. So right now, it is looking like a 10 to 15% MOS level for this company. Again, let me know whether or not you believe it should be valued like a car company or in fact like a robotics company like Elon Musk said himself. In terms of Wall Street, well, on average, they do see upside of 19%. They have a price target of $188. But as always, more so with Tesla, if you do look at analysts, they have a massive range of valuations. Some believe it is significantly lower, with others believing it should be significantly higher. And don't forget to let us know your thoughts, particularly with this one below. We then move on to the next company, which is Canadian National Railway. In fact, this is one for transparency that I do hold. It didn't have the greatest of earnings. As we can see, shares were down after report at 4.4%. When we take a look at what they reported, well, a profit of 1.1 billion Canadian dollars or 172 per share. Now, when we take a look at this last year, they did in fact report 182, so slightly lower than what they had reported last year. But also, as we can see, analysts were expecting around 171. So slightly higher than analysts, but we can see lower than last year. When we take a look at revenue, however, it was down 1.5%, as well as missing analyst expectations. So not the greatest with this company, but they have said throughout all of their earnings over the last few quarters that the first half of 2024 is expected to be a much poorer performance than the next half. So lots of big things have been discussed for the second half of 2024, so let's see if they do manage to meet those expectations. Now, we can see, even though it is down 5% over the last day, over the last year, it is pretty much down 1.3%. Year to date, down 2.3%, and if you have been a long-term shareholder, you would be up 111%. Now, in terms of the 52-week range, it is now in the mid to upper end, although going towards that midpoint. We have 2 out of 3 buy ratings, a yield on a trailing 12-month basis of 1.84%, and a forward PE just over 22. So this is a company that does trade pretty much in line with the S&P's forward PE. Dividend safety, well, one of the safest scores obtainable, very safe. Market cap 83 billion, a large cap company. In terms of those key metrics, while they increased the dividend during the last recession, they had average growth at -13, but they did also outperform the S&P at -45. Dividend growth, while high single digit at 7% just a few months ago, but over the period of the last 20 years and the last 5 years, they have been offering double-digit dividends year on year. They're also a dividend aristocrat. They have more than 25 years of consecutive increases. In terms of looking at dividend yield theory, well, we have an undervaluation signal on the yield now at 2.05%, with a forward P pretty much in line with the 5-year average of 20.9, and we see it isn't too far off the industrials 19.7 sector PE. How about the free cash flow payout? Well, again, remember, below 60% is what we target, and that is what they have had over the longer term. 2024 expected around the same as 2023 at 56%. Free cash flow, well, it has been growing over the longer term, in fact more than doubled, but we do know over the last 3 years it has been pretty much flat. 2024 we are expecting growth for the full year. Sales growth, well, again, I do believe you do have some cyclicality attributed to this essential industry, and we do note 3 of the last 10 years negative growth. 2022 a very strong year, but their more recent year we do see -2%. In terms of sales then, they have grown their top line over the longer term, and one thing I do quite like about this company is that they do share buybacks consistently over the longer period that we can clearly see here. In terms of ROIC, well, consistency again, although we do note a decrease over time, 14% in 2023, I would say that is fairly strong and attractive. Now, operating margin consistency is what I love to see on a strong metric. We see those consistent margins year on year, and the same can be said for the free cash flow. Last 4 years, very nice in the 20s. Finally, the net debt to EBITDA, what we can see below 3 year on year, 2.16 in 2023, the highest over the last 10 years, but we do know into 2024 it is expected to come down to 2.08. Now, valuation of this company, let's take a look, and don't forget you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy of companies in your own portfolio by clicking on that pinned comment below. Now, margin of safety at 10%, we can pretty much see right now it is trading at a 10% MOS level around $122. And in terms of Wall Street, they believe upside of $134 as a price target and 9%. Hence why we did see at the beginning they do consider this to be a hold. And again, as this is one that I do currently have in my own portfolio, it is one that I will be holding and waiting to see if we get a bigger discount before adding more to the position. We then move on to a company that we have reviewed fairly regularly on this channel due to the fact that it does continue to get lower and lower. It is Humana. And when we do take a look at their earnings, it is interesting to see that they have performed beats across the board, yet the market is taking this company even further. When we take a look, their first quarter EPS, 7.23. Now, it is down from a year ago, 9.38, but it did beat the consensus of 6.12. And we do see their revenues up 29.33 billion versus the prior year of 25.6, as well as beating analyst estimates. So they had a double beat. Granted, like some of the companies we have reviewed today, they haven't beat them from a previous year. And on top of that, their revenues increased on a higher per member premium and individuals. So we do know this company hasn't had essentially the best of times over the longer term. And when we do take a look today, that continues. It is down 4.3%. We do see over the last year down 37%. Over the last 10 years, however, up 188%, even after the massive decline. And we do see all-time highs around $552. It does trade right there towards the 52-week low. 2 buys, Wall Street included. And we have a yield of just over 1%, a forward P of 20 as well. Now, in terms of this company, dividend safety, it has the highest score obtainable at 99. Market cap just under 40 billion. It is a large cap company. Now, last recession, they didn't pay a dividend. They had above average growth, but they did significantly trail the S&P with their negative 72% return. We are waiting for a dividend increase soon this year, but over the last 5 and 10 years, we have seen double-digit increases. We also note they have been increasing those dividends for the last 12 years. Dividend yield theory, well, in fact, the highest dividend they have ever had over the last 5 years at 1.13%, so a massive undervaluation signal. Over the last 5 years, the forward P is slightly higher at 19.5, and we also note still slightly higher than healthcare sector at 17.5. Let's look at the free cash flow payout. One of the reasons why we see a very safe dividend score is the fact that it is consistently below 60%. In fact, pretty much below 20% for the majority of the last 10 years, 18% expected in FY24. Earnings per share, free cash flow per share looking very strong. We do see the free cash flow over the longer term increasing, but again, lots of inconsistencies, lots of drops, but after every drop, we do see it rebound. But again, one thing to note, FY24, their free cash flow is expected to drop. So a lot of things to consider, even with the margin of safety that we are about to see. Sales growth, quite nice in my opinion, double digit across the board for the majority of the last 10 years. Last 2 years looking very nice. And numerically, we can see this company has more than doubled over the longer term. As well as their shares outstanding, they are doing some nice share buybacks year on year. Although very minimal, it is fairly consistent. Now, ROIC, nothing wrong, nothing bad to note. In fact, 16% over the last 2 years, looking fairly healthy. And when we look at the margins, we can see, although very poor in terms that it isn't around the 12% we want to see as a minimum, it is something they have been having consistently. One thing that I would like to see increase slightly higher, at a minimum to the 6% we have seen on 2 occasions. And the same can be said for their margins. Above 5% isn't something that we see very often. Finally, the net debt to EBITDA, the best balance sheet that we can see with a 0 score across the board and into FY24. Won't even take them 1 day to pay off all of that debt net of cash on hand. And we can see now why that dividend has a 99 very safe score when you also incorporate the very low free cash flow payout. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you can be continually notified of these videos as they drop. Now, a 10% margin of safety with an intrinsic value of $406. We have a buy up to $366. As we mentioned, it does have a very large MOS level. Not quite there at 30% today, but we can see near a 25% margin of safety at $305. Now, when we include that and we see that Wall Street do believe there to be upside of 26%, they have a price target of $389. It does make it a very attractive company to consider for the portfolio, or at a minimum place on the watch list and take a deeper dive. As always though, do let us know your thoughts in the comments below. We then move on to a company that I believe should be on everyone's watch list, a very strong one, Old Dominion, ODFL. Now, in terms of their earnings, we can see they came in at 134. Now, it did marginally beat at 133 expected. And we can see their revenue, however, did miss 1.46 billion with analyst target of 1.47 billion. So a beat on the earnings per share, however, a miss as we can see on the revenue. Now, a bit of an overreaction, or you could argue it was already trading at a very high PE, down 11% nearly just on the day, although over the last year it is up around 11%. Over the last 10 years, up 869%, a very strong company. Now, we do get 3 hold ratings and we will do a deeper dive. We can see now trading at the midpoint, a forward yield of 0.47%, and we also note, as earlier said, forward PE 33. Now, in terms of this company, we have a very safe dividend score at 81, market cap 48 billion, a large cap company. Now, last recession, no dividend paid, so no comparative data, below average growth, but they did significantly outperform the S&P with their negative 22% recession return. Dividend growth, well, 30% increase just this year, 36% year on year over the last 5 years, so incredible to note, and they have been increasing those dividends for the last 6 years. When we take a look at dividend yield theory, well, what we can see, a significant undervaluation on the yield, but we do see the forward PE pretty much in line with the 5-year average. When we compare it though, industrial sector PE is much lower at 19.7. Now, free cash flow payout, why is it very safe? Well, in fact, it's significantly below 60%. In fact, around 20% as a maximum over the longer term, 23 expected in FY24. Free cash flow per share, as always, we want to invest in companies that are increasing their free cash flow year on year. As we can see, FY24 expected to be an increase. Whilst we do note some inconsistencies over the longer term, it is producing some very strong free cash flows. Sales growth, inconsistent. Now, this is one thing I don't like to see. We want to see at a minimum 3 to 7%. This company is a little bit different. We see some very strong years, but also noted by some negative years as well. Numerically speaking, we can see, though, it has pretty much doubled over the longer term. We also note share buybacks. Again, what we can see here is, although minimal, it is fairly consistent, which is quite nice to note, especially when you incorporate those very strong dividend growths. ROIC, now very strong, very attractive to potential and current investors, 34% in FY23, looking very good indeed. Operating margin, what I quite like about this, I'll be honest, is not just that it is at 16% above the 12, but over the longer term, it is increasing nearly every single year. They are finding operational efficiencies. Free cash flow margin, the same can be said here as well. 14-15% over the last 2 years, looking very healthy. And as we can see, an incredibly strong balance sheet. Won't even take them 1 day, as always, to pay off that debt net of cash on hand. So let's get to the valuation of ODFL. Now, as we can see, the intrinsic value is just the average of these 3 models, coming to $219. Now, current price, $196. Margin of safety at 10%. We can see a very high quality company, but it is trading at only a 10% MOS level. When we take a look at Wall Street, we can see again they do believe this just to be a hold, hence why we only have around 11% upside projected at $218. Now, as always, do let us know your thoughts in the comments below. Are you adding to any of these 6 companies that we have just gone through? Their earnings, some of them looked very impressive. Some of them didn't look as impressive, but the market took it in the opposite way to maybe what we'd expect. Let us know your thoughts. Let us know what you are thinking over the next few days about any companies that you do believe we should have our attention on. As we can see, we do have some very big names even today. We have Meta after close. We have Chipotle Mexican Grill, as well as the 2 big techs. We have Microsoft and Alphabet reporting on Thursday after close. Ultra, and we have some very nice companies, oil companies, and AbbVie on the Friday. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and don't forget, let us know your thoughts, and we'll see you all on the next one.